Well, if you're right on that, the run-up we had in the first half of January, right? I mean, which had some people saying if you believe in the January effect or the January indicator, it bodes well for the rest of the year. Not that every day can be a buy day, but how do you see this year sorting out? Again, armed with this latest data and your opinion, you've been very accurate on the Fed. So I'm just curious if they maintain the position you said, that's going to be some headwinds for people who thought the headwind days were over.
That's right. And this is all about alternatives. As investors, when we're advising our clients, we're looking at all asset classes and we're looking at our risk reward, right? When you look at equities, what is the risk reward? You take a lot of risk for what will probably be a lower reward this year. This is why we see bonds as a much more promising asset class. I know, Neil, this will put us to sleep. We talked about bonds yielding 4.5%. But in an environment where we're probably not going to see any move higher for the market this year, would we rather own 4.5% in a treasury, or would we rather sit in stocks and growth stocks that probably aren't going anywhere? And this is where I think a lot of investors are making that very same decision of reallocating more to fixed income. I think that puts another set of pressures on the market this year, that stocks are going to have to prove themselves. This is the year for public companies proving why investors should own their stocks over more dividend-paying or fixed income securities, Neil. So the market, it's got its challenges ahead of it, but we also see that the silver lining is these other asset classes like bonds, I think, are going to shine in a year like this, Neil.
We shall see. David, thank you very, very much. I had you scheduled for other things, but you flawlessly handled all of these late-breaking developments as well. Always appreciate that, David.